Also connect with Nitin Raheja. He's ED, Head Discretionary Equities at Julius Baer Wealth Advisors. Nitin, hi there. Good afternoon. Good to have you on board. Given the fact that, we have seen the FII's relentless selling, the big budget event out of the way, along with the policy in the thick of earnings season right now, are you surprised to see the markets absolutely lackluster? There, I thought of another adjective away from range bound. But, has it come as a surprise? And what is it that you're penciling in by way of a trend?
No, I think, in that sense, if you really look at it, it pretty much is following the similar script that we saw last year, right? When FPIs were actually selling very aggressively till all the way till July and August. And yet our markets sort of, pretty resilient. I think so. Domestic flows have been sort of a good offset as such. So, I mean, but in the face of such relentless selling, I would say the fact that we have not corrected is a good sign. And in that sense, also, there was going to be a reallocation the moment China decided to open up. There was going to be a reallocation because we had been one of the best performing markets last year. So, at least we think that that trend of reallocation will probably continue for another quarter or so. And that's also going to give us a chance to sort of catch up fundamentally because, we were, let's face it, one of the most fairly priced markets globally. So I think it's a mix of both. So you're seeing, liquidity flows starting to sort of adjust towards where markets have been cheaper. And at the same time, you're seeing a consolidation as far as prices are concerned, which is, sort of creating a grounds for fundamentals to catch up. So I think I won't be surprised if we pretty much see a continuation of this trend, at least for another quarter.
Then when we started the year, just about every brokerage was of the view that 2023 will be a flat year of no return for the index. And the index, despite whatever could go wrong, has gone wrong. FI selling, Adani fiasco, uptick is coming back into commodity prices, China is getting inflows. The index is there where it is. So are we in for one of those years where index may just do nothing despite this time-wise correction?
Well, you could probably see that, more likely that, the index, really trades in a range. At least I would say that that's the trend I would see for the next 6 months, Nikunj. And you really see action more stock specific than anything else.
Change after 6 months. No, when you say that you don't expect index to do anything for 6 months, what do you think will change after 6 months?
No, I think what you're probably going to see, Nikunj, is that you're going to see this whole time correction phase go through, right? And you are going to see then fundamentals having caught up. You're going to start seeing valuations starting to make a lot more sense as we start discounting FY25 onwards.
Nitin, given that the index per se is not doing anything, well, of course, the constituents are, seeing a fair amount of rotation. But that said, would you say that purely in terms of asset allocation, given the underperformance also, maybe mid and small caps are giving you a better entry point right now?
Well, if you really go and look around, you're not really seeing them being terribly cheap also. So I think in that sense, we would stick with the large caps yet.
Okay, just taking a look at some of the interesting movers for the week gone by, and of course, New Age Tech does emerge on that list. Interestingly, PB FinTech has had a pretty terrific run for this week, and if you map that chart, it's up a solid 25% nearly, so it's moved steadily from those 428 levels to 534. Paytm, of course, and I think the street really was pleased to see the kind of profits that were delivered ahead of the September guidance, the kind of commentary as well made by Vijay Shekhar Sharma. And then you've got Adani group of stocks. The recovery has been quite tremendous in Adani Enterprises, for instance, gained about 20% this week. And Adani Ports as well, seen, day after day of rallies. And then you had the number coming in. Indus Stars, another interesting mover, while you've had a Vodafone idea, of course, on a very small base that's gained about 14%. Talking 1 week chart, and ABB ditto, it's been a smart mover along with Thermax. Naresh, wanted to get in your take. ABB and Thermax on the charts?
So ABB has been in a slow and steady uptrend over the last 3-4 sessions. And overall, the longer term uptrend continues. We had a decent enough correction and the After the correction, it has slowly started moving up. So it's a buy now and dips anywhere closer to 2950 to 3000 levels. At current levels, the risk reward is not great. Thermax, on the other hand, looks more promising because the stock has been sideways almost for the last whole year. The stock was at this 2000, 2100 mark in the start of the year, as well as right now we are at the same place. Did try to make a breakout move to 2600, corrected back to 1900, 2000. In the last 2 days post numbers, the stock has done well. So this seems like a good bet, wherein the stock could slowly and steadily go towards the 2600 mark. And the whole capital goods segment, one by one, we've seen this momentum come into the names. So I would be more bullish on Thermax than ABB.
Your take then, Nitin, as to what the outlook is when it comes to new age tech. You know, we've done an analysis and it really seems that across the board, a lot of these companies are taking cognizance of profitability, talking about turning a bit adjusted EBITDA positive, and really singing the tune that the market or the street wants to hear. And they've been duly rewarded. Your view?
I don't think they have a choice, right? Because look, the global environment and liquidity scenario has changed, and every company which was hitherto having access to easy capital, whether it was venture capital, whether it was private equity capital, and the focus was essentially just growing at the cost of even losing money. I think those days are past us, right? We're living in a different era where inflation is real, interest rates are going to be higher than they are. Money has a cost vis-a-vis money which was available at virtually no cost. So I think all of them have had to go back to the drawing board. Otherwise, they would exhaust their cash buffers and they would be left prey to getting acquired. So I think in that sense, it's common sense prevailing. Business models being reevaluated, maybe even at the cost of growth. And I won't be surprised if you start seeing, in that sense, if you really go back over 20 years, around 2001, 2002, when you had a similar drying up of funding for dot-coms and technology companies. But that also laid the ground for the emergence of, the Facebooks and the Amazons of the world to transition into new business models. So I won't be surprised if some of these companies actually come up with business models and are the leaders of the future.
Right, okay. We're going to take a very quick break on that.
We've seen a lot of change in life insurance stocks post after the budget. HDFC Life, LIC, anything and everything which has got to do in the insurance space after the budget was announced has taken a knock. Is it a good time to buy into it?
I yet continue to believe that life insurance is a good long-term story, especially given the penetration. And, there is already a conversation that, there will be a different type of product. HDFC has talked about it and come about it. So I just think that, fundamentally, if you really look at it, all products where there was a tax arbitrage, the government has been looking to plug in. So, we saw that whether it was MLDs or whether we are seeing this. So I think, most people will not just buy it for tax, right? It's also got to do in relation to what else is on offer across the dimension of products that are on offer. So I think insurance business, so one, you will see in the next 2 months at least a push. And don't be surprised if you see a lot more business happening in the next 2 months. And, given that over the next year, they really come back with newer products to try and, present something which is more attractive for policyholders.
Nitin, great to have you on the show today. Thanks as always for taking the time out and joining.